So this here is an example of merchandise purchases. And what I have here on the screen is an invoice that I created through Word. And you can see here in the invoice, there's two companies here that are doing business with each other. So Haven Manufacturing Company, you can see here at the top left hand side, that is the seller. Let me actually make it a point that that is the seller. Okay, so Haven Manufacturing Company is the seller. And right below Haven, the name Haven Manufacturing Company is their contact information. And on the right hand side, yes, we know it's an invoice. And you see on here the date, October 1st, 2021. This is the transaction date. So this is the date that the transaction occurred between both parties. Then you have the invoice number of 100. This is the transaction number. Then you have what it's for. It's for t-shirts. So right below it, you see Bill 2. Bill 2 is the Break a Leg Clothing Company. This is the company that is the buyer, which is the company that we're going to focus on when it comes to recording this transaction into their books, because they are the buyer, and this is an example of merchandise purchases. Then you have their contact information followed by the name. Now, in the middle on the left hand side, you have the terms. The terms 210 net 30. So these terms that you see here are called credit terms. So whenever you see something like this, you know that cash has not been exchanged between the parties. Because whenever you're giving terms, that lets you know that the purchase was made on account. And so what 210 net 30 means is that if Break a Leg Clothing Company makes the cash payment within 10 days from the transaction date of October 1st, 2021, or by the 10th day from the transaction date, 2% discount will be applied to the cash payment that Break a Leg will need to make to Haven Manufacturing Company. Otherwise, Break a Leg will need to make the full cash payment. And that's if they make the payment beyond the discount period. So that's what terms 210 net 30 means. That N 30 net 30. They have up until 30 days to make the cash payment. So in the body of this invoice, we have the description of what Break a Leg bought or purchased. So we see there's different colored t-shirts that Break a Leg Clothing Company purchased from Haven Manufacturing Company. And then on the right side, we have the amounts. So the amounts totaled out to be $750. And just to keep it simple, I didn't include any tax rates or sales taxes. So the total amount you see here is going to be $750. So if Break a Leg Clothing Company does not, or if the company makes the payment after the discount period, then this is the amount that they'll have to pay, $750. If they make the cash payment within the discount period, this is the payment amount that they'll be making, $735, because that will be net of the discount. Okay. So right here at the very top here on the screen, you can see this is pretty much just reiterating what's in the invoice. On October 1st, Break a Leg Clothing Company purchased t-shirts on credit with terms of 210 net 30 from Haven Manufacturing Company. The purchase amount was $750. Okay. So when it comes to purchasing an item, this company is going to use what is called the gross method. Okay. So the gross method means that, or the usage of the gross method means that when the company makes the purchase of items, they're going to go ahead and record that initial purchase that was made on that date, excluding any discounts or any returns or allowances that may occur. In other words, when a purchase happened, let's just say on October 1st, you're going to go ahead, or the company's going to go ahead and record that purchase right then and there. Pretty much what actually happened on that date. So that's what the gross method means. So it's no different in gross versus net. The net amount is actually going to take into consideration discounts that were applied, returns that were applied, allowances that were applied. So it's going to take into consideration other events that can occur. But gross method, it doesn't. So it's no different than you looking at your pay stub and it shows your net earnings. That's pretty much equivalent to the net method, meaning that your net earnings took into consideration your medical insurance, dental insurance, any kind of retirement plans that you are voluntarily contributing to, taxes, anything like that. So it's taking all of that into consideration, but your gross earnings is not taking any of that into consideration. Okay, so it's the same principle. So when it comes to the gross method, we're just pretty much going to record the purchase that occurred on October 1st. So I'm going to set up this general journal here with the date. I'll put on here transaction number. And then I'm going to put on here general journal. This is where I'm going to put the account description under. Then we have debit, good old debit and credit. Okay, so the transaction number is going to be 100 because that's what is displayed on the invoice. So I'm going to put on here 100. The date that we're going to use is going to be October 1st. Okay, so for this entry here, we're just going to record the initial purchase that was made. So the initial purchase that was made that we see here on the invoice, we have to know what it's for. What was it for? Okay, so it was for t-shirts. We can see here it's for t-shirts. Okay, so since the initial purchase was made for t-shirts, and oh, by the way, this is Break-A-Legs. Oops, there we go, Break-A-Legs. General journal here, just so we know. All right. So the initial purchase was made on t-shirts. Break-A-Leg is in the business of selling t-shirts. So this means that the account that's going to be affected and debited is going to be an account called merchandise inventory. Okay. So we know that account is affected and it will be debited because since inventory is an asset and we're going to increase our asset account because Break-A-Leg acquired t-shirts, we're going to have to debit it. Okay, now for what amount? Well, since this is the gross method, which means that we are recording this transaction as it occurred on October 1st, we're going to just take the full amount of $750 here. And that's what we're going to debit to the merchandise inventory account. Okay, so $750, that's going to increase the balance in that account. Next thing we have to do is we have to now answer the question, well, how was this merchandise inventory acquired? Well, on the invoice, we have terms 210 net 30, which are credit terms. This tells me that the merchandise was purchased on credit. So since it was purchased on credit, we're going to credit accounts payable for $750. And that's going to also increase the balance in that account since accounts payable is a liability. All right, so this is the purchase of t-shirts with terms 210 net 30. Okay, so this is when using the gross amount. All right, so let's say that the payment was made within the discount period, and we'll use a different transaction number. I'm just going to put on here transaction 101, and we'll say that the payment was made on October 8th. So since the cash payment was made on October 8th by Break-A-Leg, we know that that's a payment that was made within the discount period. Okay, so we scroll over here. 10 days from October 1st is October 11th, which means that Break-A-Leg has up until the 11th to make the payment to be honored the discount of what, 2%. Okay. But since they made the payment on the 8th, hey, they made the payment within the discount period, which means that we scroll down here to the invoice. This net of discount amount of $735 here, that's going to be the cash payment here. So to account for the discount or the payment made within the discount period, first thing that I like to do, because I'm going to take this on a step-by-step basis. The first thing that I would like to do is get rid of the liability that's sitting in the accounts payable account because the cash payment was made. So we're going to go ahead and debit accounts payable for $750. Okay, that's going to decrease the balance in that liability account. So we've officially eliminated that liability that we initially recorded on October 1st. Get it out the way. Okay. The next thing I would like to do is go ahead and credit cash. Account for the cash payment that was made. Okay. So the cash payment that was made is not going to be $750. It's going to be a different amount. Again, it's going to be $735. But let's say that you wasn't given this $735 on the invoice. You have to figure out what the discount is going to be. So you're going to take $750. Oops. Now there are a couple of things that you can do. You can either take $750 and multiply it by 98% to get $735. Or you can take the $750, multiply it by 2%, right? 2%, and that's going to give you $15. And then take $750, subtract out 15 to give you your $735. Either way, it's completely fine. And as far as how you're able to get to the answer, but as long as you're getting to $735. That's all that matters because that's the correct amount that should be credited to the cash account. Okay, so I'm going to go ahead and put $735 as a credit to the cash account. So that's going to decrease the balance in the cash account because that's the cash payment that went out. Now you notice there's a difference here. We have a debit of $750, a credit of $735. So there's that $15 difference here, which is going to be credited, okay, to what is called merchandise inventory. So it's going to credit that account, which is going to decrease the balance in that account. Now, why is it that that's the case, that difference goes into merchandise inventory? Well, because the cash payment that you made of $735, well, the merchandise inventory account needs to match that cash payment because the cash payment that was made, what was it for? It was for merchandise inventory. So the merchandise inventory amount needs to match the cash amount as well. So when you credit $15 into the merchandise inventory account, now the balance in the merchandise inventory account is $735, which matches the cash amount as well. All right. So let's say that the payment was made after the discount period. So we're just going to take transaction 100. That's what we're going to be focused on because we essentially are going to take this transaction that occurred and we're just going to go off of that, not go off the second transaction, because this second transaction here, I'll just put it down here. This is payment made within discount period. All right, so let's say that this is transaction 102, and we say that this payment was made on October 13th. Okay, so since the payment was made on October 13th, we know that the payment was made after the discount period, which means that if we go back up here to the first transaction, transaction 100, we're going to go ahead and eliminate accounts payable for $750. That doesn't change actually, because that was what was recorded in the first transaction. So we're going to go ahead and let's see, debit accounts payable for $750. Okay, so since the discount wasn't applied because the cash payment was made after the discount period, the cash account is going to be credited also for $750. Okay. And that's how it's done. Let's see, payment made. Oops, made her. It's kind of hard to write and talk at the same time. Made after, there we go, after the discount period. Okay. All right, now I'm going to go over here to the other side here, because there can be some other things that can happen when it comes to adjusting a balance given the purchase that was made. Returns can happen, allowances can happen, other things can happen besides just adjusting your books to account for a discount. So as you can see here, the very top, this is going to be a scenario of when an allowance is actually provided to the buyer. So on October 7th, Break a Leg agrees to a $20 allowance from Haven Manufacturing for defective t-shirts. Record the allowance for defective goods. So this can actually happen. So let's say that Haven Manufacturing sent off some t-shirts to Break a Leg. Break a Leg gets the t-shirts, open it up, and they did purchase it. And we're just going to assume they purchased it on account or, on credit. They open up the box and they see all of these t-shirts, and then there are a few of them that are defective, or there's something wrong with them. Meaning that they're probably not going to sell those, or if they do, they're going to significantly reduce the price on those t-shirts. Either way, those t-shirts are defective. There's something wrong with them. So Break a Leg can, contact Haven and say, hey, we got a couple of t-shirts that doesn't look right, or a few t-shirts that doesn't look right. And Haven can, just try to, because Haven wants to keep them as a business, as a customer, because they are the seller. So they can say, hey, okay, we'll give you an allowance. We'll give you an allowance for a certain amount to, account for those defective t-shirts. That way, that will reduce your payment amount on either the current order that was made or even future orders. That's going to depend on the buyer and seller's, agreement. So that can happen. So allowance, okay? So how to account for the allowance? I'm just going to put on here the date. I'm not going to put a transaction number. General journal. Debit and credit. So scrolling over here to transaction 100, the first transaction, let's assume that we're basically following this transaction here that occurred on October 1st. So we're going to say on October 7th, there were some defective t-shirts. Haven Manufacturing provided Break a Leg Company an allowance of $20. So what this is going to do for Break a Leg is reduce their liability. Okay, what they actually owe is going to be reduced. So from $750 here, as you can see, from $750, it's going to be reduced by $20. So this means that accounts payable is going to be debited for $20. Okay, that's going to reduce what they owe. And then the credit is going to go to merchandise inventory. by that same amount, $20. That's also going to reduce the balance in that account. Because all what Break a Leg is doing is, number one, they're reducing they're reducing the amount that they owe. And number two, they're going to reduce their inventory balance because they're going to take the inventory out of their floor. They're not going to put it out on the floor pretty much. So they're going to reduce the amount in their inventory account. They're not going to sell that to anyone at I want to say at retail. So hopefully that makes sense. So that's how to account for purchase allowances. All right. Now here we have an example of purchase returns. So it's not really that much difference when it comes to allowance and returns as far as what accounts needs to be debited and what accounts needs to be credited. Not that much different. But here's an example here. So this is pretty much a reiteration of what was actually on the invoice, and also just the returns that happened, and also if payment was made within a discount period. So there's a few things that we need to do here in this scenario. So on October 1st, Break a Leg purchases t-shirts in the amount of $750 with 210 net 30 terms. So let's go ahead and record that. So if that's for number one. I'm going to put on here date. I'm going to put on here general journal. Debit and credit. So record the initial purchase of the t-shirts. Okay, so the initial purchase on the t-shirts occurred on 10/1. Okay, so when the t-shirts was purchased, it was purchased with credit terms. Okay, so that's great. So we're going to go ahead and debit merchandise inventory because inventory was acquired in the amount of $750 because we are using the gross amount. Okay, how was it acquired? Well, we have credit terms here of 210 net 30. That lets us know that cash was not exchanged. So accounts payable is going to be credited for $750. So this is using the gross amount here. This is excluding any discounts, returns, allowances. This is just we pretty much are just recording the transaction as is, as it happened on October 1st. All right. So it says on October 4th, Break a Leg returned $60 worth of t-shirts to Haven Manufacturing Company. So number two, record the return items. So the items was returned on 10/4. So to record the return items, we're just going to take the first entry here, and when it comes to the accounts, and we're just going to reverse it. We're going to flip it. So since items were returned, we're going to debit accounts payable for, let's see, $60. Okay, that's going to reduce the balance in the accounts payable account, or reduce what Break a Leg Clothing Company owes, and we're going to credit merchandise inventory by that same amount, because the company's not going to include that in their inventory account, because they're not going to include that as them selling that to the customer, or include that out on the floor for customers to buy. Okay, then number three, last one. So on October 8th, Break a Leg paid for t-shirts within the discount period. All right, now we got to record the payment that was made within the discount period. So this happened on the 8th. So payment was made within the discount period, which means that we got to do a few things here. The first thing we need to do is we need to figure out what our updated accounts payable balance is. So we take our $750 here, and we subtract out our not that account. Come on now. Again, I told you it's hard for me to talking right at the same time. Okay, we're going to take the balance from here because that's the accounts payable account. We're going to subtract this $60 from this $750. Okay, that's going to give us $690. So this is our updated accounts payable balance prior to October 8th, or as of October 8th. So this means that since the cash payment was made on October 8th and our balance in our accounts payable account is $690, we're going to go ahead and debit this account or this amount to the accounts payable account. So accounts payable, it's going to be debited for $690. Okay, that's going to eliminate the balance in that account. Next thing we're going to do is record our cash payment. So that's the second step. So this was the first step. The second step is to record the cash payment. So the cash payment is going to be figured out from this $690 here. So we're going to take $690, multiply it by either 98%, which is $676, or you can do the $690 multiplied by 2%. That should give you 14. Take $690, subtract out 14. That gives you $676. Okay, again, either way you get to the correct answer, that's fine. Or to get to $676, that's completely fine. As long as it's that amount, that's great. So this is the cash payment that was made on the inventory. So we're going to credit cash for $676. So the difference of 14, okay, is going to be credited to merchandise inventory, because we're going to have to reduce the balance in the inventory account to match the cash payment that was made. Okay, so just to do a little check, you take $750 right here in inventory. Okay, that's a debit. I'm gonna put DR for debit. Subtract $60, which is a credit. Okay, what does that give you? That should give you $690 as a debit balance. Then from this last entry here, you're going to subtract out 14, which is a credit. That's going to give you $676 as a debit here, once this entry here is made. So this amount matches the cash amount here of $676.